If your agency has remote employees in multiple states, you may have created a tax problem without realizing it. Not because you did anything wrong intentionally, but because one employee working from another state triggers payroll tax, workers' comp, state filings, and compliance obligations you may not have planned for. And when your agency is finally making real money, that's when these surprises hurt the most, because it starts to feel like too much of your profit is disappearing. Hi, I'm Cody. I'm a CPA, I'm a certified tax coach, and we work with marketing and PR agency owners who want better cash flow, stronger tax planning, and cleaner financial decisions. Today, we're talking about one of the hidden tax problems of growing a remote agency, hiring employees in multiple states. Remote hiring can be great. It gives you access to a better field of talent. It lets you hire the right strategist, the right account manager, paid media specialist, or creative lead without being limited by your geography. But here's the problem. The tax side does not disappear just because the employee is remote. In fact, the tax side gets more complicated. In this video, I'm going to walk you through what agency owners need to watch before hiring out-of-state employees and how to avoid turning growth into tax leakage. Number one is remote hiring can create payroll obligations in another state. Most people are well aware of this, but just let's say your agency is based in New York and you hire strategists in North Carolina. Then your paid media manager moves over to California. Then your accountant director moves and starts working in Florida. From an operations standpoint, that may seem simple. Your team is still doing the same work. Clients are still being serviced. Projects still move. But from a tax standpoint, each state may look at your employee and say, your business now has responsibilities here. And that starts with payroll, but can lead to other taxes. You may need to, and most likely will need to register that employee's state for withholding tax. You'll also have to register for unemployment tax. Each state has different requirements for payroll deposits, and typically your payroll service will handle that. But the thing that nobody is watching is the income tax portion of that. Do you create an obligation to pay tax in that state? And this is why remote hiring should not be treated as just an HR decision. Before you say yes to a remote employee in another state, ask, what does the state require from us? It's not just about payroll. They may have different human resources requirements. They may have stipend requirements for remote people, such as California and certain counties in California. If they use their cell phone and internet, you need to give them a stipend. You need to look at all these things. So the first rule is simple. Do not let employee location become an afterthought. Know where your people are working and make sure not just payroll, but HR and your CPA all have the same information. Workers' compensation and state insurance rules may change from state to state. Payroll withholding is only the first layer. The next layer is insurance. If you have an employee working in another state, you need to confirm that your workers' compensation coverage applies in that state. Do not assume, check. Some states also have paid family leave programs or other state-specific insurance requirements, and those requirements may not match the rules in your home state. And this is where I've seen agency owners get caught. They say, we have workers' comp, but that's not the complete question. The better question is, do we have the right coverage for where our employees actually work? And this all matters because the larger your agency gets, the less room you have for sloppy compliance. You have enough moving parts already: retainers, project work, media management, creativity, client strategy, utilization, hiring, cash flow. You don't want to get hit with a preventable payroll or insurance penalty, notice, distraction. Remote employees can be a great asset. We have loads of them. But each new state needs to be reviewed before the employee starts working there. The third point is a remote employee may create a state income tax filing obligation. And this is the part that we see most agency owners miss. When you hire someone in another state, you may create what is called nexus. In plain English, that means, and if the state considers your agency to be doing business there, your agency may have to file a business tax return in that state. And if you're a pass-through, that means you're going to file a personal return there. That affects corporations, S-corporations, partnerships, and in many times, it's going to affect you personally. So it's no longer just a payroll issue. It becomes a state income tax issue, and it becomes a business filing issue, and more often than not, a personal filing issue. And that's a totally different conversation than, can Sarah work remotely from Colorado? The better question is, what does Sarah working from Colorado do to our tax filing requirements? Now, this doesn't mean you should never hire remote employees. I said we have remote employees in 5 different states. The point is that the tax planning has to happen before you hire, not after the state sends you a notice. Because once you receive a notice, you're reactive. And tax planning should not be reactive. It should be proactive. That is how agency owners are going to protect their cash flow. Let me ask you this. Do you actually know how many states your employees are working from right now? Not where your office is, not where they were hired, but where they physically sit and do the work. Drop a comment below. Let us know how many states is your agency operating in today. And we're not even talking about compliance and filing requirements based on sales. We're just really talking about those that are triggered by having a remote employee in a different state. Point 4 is remote hiring affects your real agency profit. Agency owners love remote hiring because it opens up the talent pool, and I understand why. Finding good people is hard. Finding good agency people is even harder. So if you can hire that right account manager, designer, or strategist outside of your local market, that can be a very smart move. But you need to understand the full cost. The salary is not the full cost. The full cost may include, in addition to payroll registration and state unemployment registration, workers' comp, paid leave requirements, additional tax filings, CPA time, additional tax filing fees, and possible state tax exposure. And if unfortunately you're trying to run your agency based on gross income, okay, this matters. Because gross revenue is not the number that tells the real story. Agency gross income is the number that matters, and that's the money you actually have left to run the agency after pass-through costs. So when you hire remotely, don't just ask, can we afford the salary? Ask, can we afford the total cost and still protect our agency profit? Because growth is not just adding people, growth is adding people in a way that keeps the agency healthy. If every new hire adds complexity, cost, and compliance problems, then your agency may be getting bigger without becoming more profitable, and that's not scaling. That's just creating a more complicated business. Point 5 is build a remote hiring checklist. Here is the practical solution. Before any employee works from a new state, create a simple hiring checklist. First, confirm the employee's actual work location, not just where they live, not where they want their mail sent, where they are actually working. Second, ask your CPA whether that state creates business filing requirements. Third, ask your payroll provider what registrations are needed for withholding and unemployment, and confirm that your workers' comp and any state-required leave coverage you have. Fifth, estimate the annual compliance costs before approving the arrangement. And 6, document the decision. And the last one matters because as your agency grows, these decisions pile up. One employee in one state may not feel like a big deal, but 3 years later, you may have employees in 7 states, payroll registrations in a bunch of states, tax filings in a bunch of states, and no one's sure who's tracking what. And that's how the agency will lose control of the tax picture. And once the tax picture gets messy, cash flow forecasting gets harder, tax planning gets harder, profitability gets harder, and the owner starts asking, why are we making more money but keeping less of it? A lot of time, the answer is not one big mistake. It's a series of small decisions that were never run through a tax planning filter. So let's recap. Hiring remote employees can be a smart growth move for marketing and PR agencies, but it can also create hidden tax problems. Number 1, you may need payroll withholding and unemployment registrations in the employee state. Number 2, you may need a different workers' comp policy, a paid leave policy, or other insurance coverage. 3 is that employee may create a state business tax filing obligation. And number 4 is remote hiring has to be measured against your agency gross income and real profitability, not just the salary. And number 5 is you need a remote hiring checklist before the employee starts working from a new state. My goal here is not to scare you away from remote hiring. The goal is to make sure growth does not quietly turn into tax leakage, because your agency can be growing and still be leaking profit. And if you're not looking at the tax and client side, you may not notice until it's already costing you money. If your agency has remote employees in multiple states, or you are about to make your next out-of-state hire, this is exactly the kind of issue you want to review before it becomes expensive. Make sure you speak with your CPA. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.